Welcome back to the podcast, White. And today we'll be tackling a question which I've heard a lot in the last while from our business owners, from professionals, and from families who own appreciating real estate. And from a tax perspective, really, where should one own real estate? Should it be personally held? Should it be held inside of a corporation or through a family trust? And specifically, what structure would provide the least amount of tax and give you the best net tax result on eventual sales? So, and this is one of those questions where bad assumptions can result in hundreds of thousands of dollars of tax. So let's break it down clearly. We're going to be using Ontario, real numbers that really produce practical outcomes. So from a big picture perspective, in Canada, tax efficiency is not about where you pay tax first, but how many times that dollar pays tax. And some structures will provide two levels of tax, and in some structures, you'll have the dollars taxed once. So let's walk through three specific structures and three specific holdings that produce different tax results to make our point here. Personal ownership is the first, and let's compare them using the same property, the same sale price, the same terms of sale, same net capital gain. So $1.5 million property that has an adjusted cost base of $700,000. Selling fees, filter fees of $50,000 gives us a capital gain of $750,000. And using the top tax bracket here in Ontario, really 50% of capital gains would be taxed. And so altogether, provincial and federal tax come to 26.8%, just below 27% of that gain is taxed. So 27 and every dollar goes back to Ottawa. So that's $201,000 of tax. And so your net amount with the $50,000 fee adjusted, your net result is $1.25 million. Pretty clear, pretty simple, personal ownership, one layer of tax, and the net result of $1.25 million. We do not consider this principal residence, so we're not going to speak on that. But just to note, of course, we know principal residence attracts a zero tax, so that would provide the best result in every case. Case two is the holding company ownership. So properties held in whole or real estate investment codes or corporations in general. Corporations pay tax on their gain, and half the gain, of course, is going to be taxed, but the other half creates what's called a capital dividend credit. So this capital dividend account gets credits by the half of capital gains that are not taxed. It also gets credits from life insurance proceeds, but in this case, we're talking about the half of capital gains that is not taxed. So that portion, those credits, can move to the shareholder free of tax, essentially creating a one layer for the shareholders. And more on that later. But really, the critical question to ask is, what happens when the shareholder wants the proceeds? How does that work? When the shareholder has uses for the money, how many times will they be taxed and what will that look like? If the money stays inside the corporation, of course, well, really, this is the ultimate deferral. And this is where corporations are quite powerful in the tax planning realm, where corporation would have one layer of tax. It would roughly be about $188,000, and that would leave $1.26 million of net proceeds after tax, after fees, and those proceeds stay in the corporation. Nice. So not tax savings, but of course, if you were never going to take the money out of the corporation, then it would be never-ending deferral, not tax savings. But of course, shareholders have uses and needs for their capital, and certainly all of our clients do. So we don't need to think about when the money gets held personally, when the corporation distributes the money to the shareholder. So now we're looking at, capital dividend, the half of capital gains not taxed, coming through to the shareholder free of any tax. That's $375,000. It's really good. And then, of course, the remaining cash paid is taxable dividends. Personal dividend tax are top rates. So altogether now, because the corporation had to pay tax and now the shareholder pays tax, the double tax exceeds $5,000. That's $550,000 of double tax on $1.5 million property with a capital gain. As we spoke about, half the capital gain creates a dividend tax credit, and the other half, of course, is taxed fully. So $750,000 capital gain. So we can see very clearly that that the corporation with this double tax effect leads to the worst, or certainly compared to the personal holding, it is actually more than double the tax that you would pay if you held it personal. So this is where corporations, again, create great planning opportunities because of the tax deferral opportunity, but they're rarely good for minimizing lifetime tax on appreciating real estate. So unless the money never comes out of the corporation, there's really no opportunity for the corporation to do better in a tax planning point of view. So let's move on to our third example, the inter vivos trust, the family trust. And trusts are like top income earners, who are top tax earners, or top taxpayers, we should say. So trusts are like an individual who earns, above the $240,000 of income that gets taxed at a top tax rate. Of course, capital gains rules applies to trusts. And trusts are just like individuals or corporations. They're entities that have to file taxes. Of course, trusts have the concept of capital dividend account or capital dividend credit. And certainly, there's no concept of principal residence exemption. The trust doesn't have any of those that apply. So looking at the trust, it does provide value from a perspective that the capital gains now can be allocated to multiple individuals. The trust will have multiple beneficiaries. And so if the beneficiaries pay tax at a lower rate than the primary owner and the primary beneficiary, then the sum of those tax bills would be lower than if the primary beneficiary owned all of the tax on their own at their high rate. So there are planning opportunities within the trust. There is no question, but there are also trade-offs because the trust has to consider all of its holdings sold every 21 years. So if this plan and this asset is held for longer than 21 years, it is going to be considered sold or deemed disposed, is how CRA language. What that means is that only to find the tax that is related to the gain of those assets is this deemed disposition concept applied. And then that would give rise to a tax bill in that period, in that current period. So you can see that if your plans are beyond 21 years, the trust is going to create another tax bill, which is not very favorable in tax planning, obviously. Trusts are complex and they require their own tax filing, administration. So that, of course, goes along with the cost and the certainty of outcomes for the long term. Trusts are also guided by a lot of policy that can change. They have been reasonably ironclad, but not perfectly. So their long-term outcomes can be uncertain to some degree. But trusts don't automatically create a tax savings. They create a financial flexibility to split the tax bill among individuals. And they also have, of course, allow people to essentially rule from the grave. From a tax perspective as well, any perspective. So structures that produce the least tax on appreciating real estate from top to bottom. Personal ownership is the best way that produces the least amount of taxes on eventual sales. Of course, we're not talking about principal residence, but principal residence attracts no tax. So that's worth noting. But as investment property, holding that asset, whether that asset is here in Canada or a foreign asset, holding it personally will subject you to one layer of tax, which is ultimately the least amount of tax among these three ownership structures. The second best is a trust. As we said, as long as that asset is going to be, the holding period will be 20 years or less.